Hi.
Good evening, everybody. This is Matti from Zerodha. Today we have with us Mr. Sriram Krishnan, Mr. Gaurav Motwani, and Ms. Rachna Bhusari, all from NSE. They're here to do an investor awareness program to help you understand what NSE is doing to help you and also what you need to be careful about while investing. Mr. Sriram is the Chief Business Development Officer at NSE. Gaurav is the Chief Manager of Investor Empowerment and Capacity Building and Investor Services at NSE. And Rachna is the VP of Investor Awareness and the social stock exchange that NSE runs. Gaurav, Sriram, and Rachna will be taking us over the next hour on what investors can do better and what NSE is doing to help them. Over to you, Sriram.
Thank you very much. Thank you very much. These were very kind introductions at the very beginning. My name is Sriram, and I'm very happy to be here today with you. NSE, as you know, is not only the largest stock exchange of India, but also the largest derivatives exchange in the whole world. In recent years, we have seen an enormous increase in trading volumes, particularly in equity derivatives. And millions of Indians, particularly young Indians, have started trading futures and options. Alongside this trend, we also have to acknowledge the downside risks that go not just with trading in futures and options, but in general in various other products which are available today compared to what were available, let's say, 20, 30 years back. If you look at the history of how India has evolved and how the capital markets in India have particularly evolved, it's very clear that with growing investor confidence, there is also an appetite which has been growing equally for people to invest in products which are somewhat risky without realizing what the repercussions are. Hence, to build investor awareness and to educate investors from time to time about various aspects, NSE has devoted a massive budget as part of its overall initiatives. And we have decided to roll out a number of programs. And this is one program with Zerodha, which we are very proud to be associated with and which we are sure will help investors in a significant way. This investor awareness program is a small step, but an important step from our perspective for bringing their customers onto this particular call. And we hope to do many more such initiatives with Zerodha. And we wish each and every one of you a very productive session today. And we hope you take care of the important do's and don'ts which are going to be shared in this session. And we really hope that your investment journey is one where you're safe and sound, and more importantly, you're fully aware as to what you're getting into. Thank you so much, and I would like now to hand it over to Gaurav. Over to you, Gaurav.
Yes, thank you so much, Sriram. So my name is Gaurav Motwani, as I've been introduced. I'm working with National Stock Exchange for the past 14 years, especially related to investors. So we started today's session, which is one part of our session is regarding investor awareness. Are you able to see my screen? I have shared my screen. Is it visible?
Yes, Gaurav, we can see your screen.
Yeah, thank you so much for the confirmation. So there are two parts to this particular program. One, we will cover the basics of capital markets, which I will be covering, post which we have a session by Rachna, which will be for some active investing. So we take you through the journey from account opening right up to what the things that we should and should not do. So first, this particular model is who should be going through this model. So anybody who's invested only in fixed deposits and gold so far, they've been wanting to explore different other investment avenues. They know some basics about the markets, but want to learn more about the capital markets, about demat account, the brokers, and stock investments. So we'll start with some of these basics. So hopefully we will be able to do some justice. So this is the agenda through which we will start. The first part of it is we will cover what is capital markets and its structure. Moving forward, it will be primary and secondary markets, then active and passive investing. Then third part will be the investing in securities market, followed with know who your broker is, then account opening and documentations, and dealing with the broker, and a lot of myths that are there are surrounding the capital markets, which you will try to. Right. So moving first to the first topic that we have is, what is capital markets? So very, simply diagrammatically, if you can see, it's presented over here. Simple. It's a place where buyers and sellers come together and they can buy and sell instruments. It could be stocks, it could be bonds, etc. So there are different participants that are there in the markets who make the capital markets. So they are individuals, they are institutions who are there, and this is governed by SEBI. This is a basic introduction of the capital markets. So we talk about SEBI for a moment. So basically, SEBI is our regulator, and it was formed as an administrative body with the Ministry of Finance in 1988. So it's an autonomous regulator under the Act of the Parliament. So you see, they have three main objectives. If you see the first objective that is there as per SEBI's mandate is investor protection. That is the first and foremost objective for them. Then comes the regulation of the securities market, and third would be development of the securities market. And if you see the entire structure of our capital markets, how is it built? So on one part, we have investors. Most important part is the investors, hence they're on top. Then we have the stock exchanges, we have the clearing corporations and depositories who provide services. And then apart from them, we have stockbrokers, investment bankers, mutual funds, etc. And lastly, we also have the companies, social enterprises, and the PSUs on which the trading happens. So these are the, in short, the structure of the markets and who are the participants in the capital market. And then moving forward, we'll cover primary and secondary markets. So primary markets, what are primary markets? Anytime a company issues the shares to the investor for the first time directly, that happens through primary markets, and then the company will issue the shares. So an investor invests in companies and the company issues the shares directly. So that happens in the primary market. And secondary markets, these are already shares which have been issued, and then they are listed on the stock exchanges and trading happens through them. So in the primary markets, the other parts is how is the price determination. So the price is not determined. The price here is determined and decided. A range is decided by the company in consultation with the merchant bankers and everyone. And then in secondary market, it's the supply and demand. What investors buy and sell, the supply and demand that determines the prices. Then in primary markets, the key intermediaries are your merchant bankers, the bankers, and the RTAs, which is the registrar and transfer agents. The secondary markets, those are stockbrokers and depository participants. So they serve different purposes. The primary market serves the purpose of raising the capital. That's the primary purpose. And in secondary market, it is basically the trading of securities to provide liquidity to investors who own the securities to get liquidity. So that's the difference between the two markets of primary and secondary. So we'll come to another concept of active investing versus passive investing. So if you see there are two different types, so we'll cover what active investing is first. So active investing is any form of investing where you are working for your own, working for an income, and you aim to beat the entire markets. It involves actually buying and selling of securities. You open an account and buy and sell securities. You aim to outperform the index over here, and you can exit at your own convenience. And the active investing involves it's not as tax efficient, and fees, etc., are slightly higher, right? So these are the facets of your active investing. When it comes to passive investing, here you're only investing where you try and aim to get what the market is giving you returns. It's to track the markets and give you returns what the market is giving. Say for example, Nifty 50. So they track the Nifty 50, and what returns come from the market is the returns that you will get on your investments. That's an example. It involves basically holding the ETFs and mutual funds. It is less likely to outperform because you're only tracking and trying to replicate the returns that are coming from the market. Then there's definitely a lot of transparency over here because you know what stocks are there in the index, and that's the ones that you're trying to buy. And it has lower taxes, and there are advantages of capital gains tax as well, right? So these are the two facets of form of investing, active and passive. So at the moment, the first time the investor comes into the market, we would suggest that, they would, choose a passive form of investing, learn all the facets that are there, all the, how does the capital markets function, and then move into active part of investing. That's what Sriram was trying to point out. So if you see the returns that have come from the different asset classes over the last 30 years, So we have taken the CAGR, which is a compounded annual growth rate over 30 years across different asset classes. So if you see an inflation of 6.7%, and if you see silver, the fixed deposits, gold, and PPF are around 8 to 9%, right? But if you see equities, then it is around 15%. So these are the returns from different asset classes. Hence, there is a need to move towards investing in asset classes that can give you better returns. So if you see the markets, how they have performed, when you see right from 2003, if you see the data over here, capital markets don't function and go unilaterally in one direction. There are lots of ups and downs that happen throughout the market. So we have marked a lot of important history, like be it the financial crisis, be it the the market crash of China, the COVID. So we have gone through many ups and downs throughout, right? But if you see consistently over a longer period of time, that's what when we invest money, we need to invest for a longer period of time. So no matter the ups or downs, eventually at the end of the day, as we saw in the previous slide, the returns are positive, right? So we have to be very consistent, be disciplined in how we invest, and don't try to outperform the market. Hence, we will be able to achieve those returns, right? So it's not that you buy at one point in time, suddenly some crisis happened, you panic and you start selling. That's not how it functions, right? You have to let the market to correct. There will be ups, there will be downs. So history has shown that over a period of time, you will get positive and good returns if you are consistently invested in the market for long periods of time. Then, now, assuming that we know how to invest in we are convinced that we need to invest in securities market. The three types of accounts that we need to have: one is a demat account, one is a bank account, and one is a trading account. A lot of trading members do provide 3-in-1 accounts, so that's another option to open an account with. And in case you're applying only in IPOs, or if you are applying only for mutual funds, then you may not already necessarily have a trading account. You can have a demat account, or you can also go for, in case of a mutual fund, it can be physical also, right? So primarily, if you want to invest in all the products that are available in the market, these are 3 accounts that you need to open, and they can be done offline as well as online. So one important point which I like to highlight here is providing nomination is very important. Initially for demat account, it was mandatory. Now for trading account also, it has been mandatory. So either you have to opt that, yes, I am going to provide nomination, or opt out of nomination. So either you have to provide nomination or opt out of it. That is mandatory now, right? So assuming that you want to open the account, so who's the broker? First, you need to understand the broker, because broker is through which you're going to invest all the funds. He's also the person who's going to provide you the services. So a background check is very important. What is the registration details of the stockbroker? Is there any regulatory action that the regulator or the exchanges have taken against the broker? What are the number of complaints that are there in the market against the brokers? So there's some mandatory background checks. If we check, it will be very good for us as individuals. So other details like, what are the modes through which you can place your order, whether they provide online and offline facility, what are the brokerage charges, what are the other services that they're offering, like, applying for mutual funds, IPOs, can you do through their trading platforms? A lot of advisory and research services some of them provide, a lot of tools they provide for learning. So these are different facets that you need to check before you get involved with open an account with a stockbroker, right? So I'll take you to some of the very important documentation that even if you've opened an account, it will still give you time to go back and review certain things that you may need to. So there are 2 types of documents that are there. One is a mandatory document, the other one is voluntary. As the name suggests, mandatory are the ones that you have to definitely sign and then open the account. Voluntary are the ones that are optional. It is given for your own convenience, and only if you want to avail the services should you opt for it, right? So a lot of us, it happens with all of us that due to time constraints, we just sign wherever the box is given to us. If sign and give it to us. So a sincere request is like, should we please read those documents and then only sign. It is our own hard money that you're putting in. So that's something that I would like, I would want everyone of us to follow. So documentation, PAN and Aadhaar are enough for us to open the accounts. And if you're opening it through online, then you have a signature image and your camera enabled. So these are the certain documents and things that you will require to open an account. So there's a copy of the account opening form. Then is the UCC, which is a unique client code. Every single client, whoever opens an account with a stockbroker, gets a unique client code. That is how you determine who the person is with this stockbroker. Then there are details of address and contact number that the broker will take. There's a user ID and password that will be given to you in case you're trading online, which is very unique to you, and obviously should not be shared. Then complaint details of in case you have any issues, on which email ID or which phone number is supposed to contact the stockbroker. Those details will be provided to you in the account opening form. Then every trade that you have conduct, there's a contract note being given to you. So contract note and statements and weekly balance. Every week you will be given the balance of funds and balance of securities that are available with the stock, right? So these are things that are involved once you open an account and what you're going to get. So in continuation to what we are going to get, the way we discussed, there's certain communication that will come to you from the exchange. So earlier slide, we discussed about what is going to come to you from the stockbroker on a weekly or monthly or basis. And this is what will come to you from the exchange point of view. You'll get a welcome email once you open an account with the stockbroker. Then there's a day end free SMS of the trades that are conducted by you and email alerts as well. Then there's a weekly balance that will come to you from the stock exchange as well as from the stockbroker that was shown in the earlier slide. And what do you do with this information? First thing is to read and understand what is the documentation that has come to you. Second is verify whether these are the trades that you have conducted and the quantity or the value on which your trade was bought or sold. And third, most important part, in case any issues, then you report the discrepancy to your stockbrokers. They will have some time, they will revert to you with whatever is required, right? So now assuming that the account has been opened, and how do you place orders with the stockbrokers? As I told you, there are a lot of facilities provided by the stockbroker. When you open an account, we discuss with the stockbroker as to what facilities we will get, right? So the different ways and modes through which generally orders are placed is visiting the stockbroker's office, over a call or email, or even today the most famous is the online trading, either through the app or the website access which the brokers will provide to you. So proof of placement of order is mandatory, which the brokers will keep on your behalf. So the cycle goes like so that first to place an order, the trade gets executed, then the clearing happens of the particular trade, settlement, and then the pay in and payout. This is how the cycle will work. So moving ahead, assuming that we have made a trade and we've got a contract note. So as I said, we need to check, certain things in our contract note. That's what we were discussing in earlier slide. So there we'll point out certain points which are very important for you to note. So those are highlighted in red. So basically, it has to have a digital signature of the broker. Then it has to have the broker's name, address, and the SEBI registration number. Please also check whether your PAN and unique client code is mentioned. And then this is the more other important part where all your details regarding the trade is captured. Your order time, order number, your trade time, trade number, the security that has been bought or sold, the price at which it is bought or sold, the brokerage that you will be paying, and what is the net by your net pay in or payout, right? So these are the important things that you need to check in the contract note. So basically, it is an evidence that the trade has been executed, what time you placed the order and what time the order was executed, right? So basically, the mandate says that it has to it should be signed and issued within 24 hours. But these days, advent of technology, definitely all this is reaching to us immediately at the end of the day itself. A lot of them also come on real time to us. So this is an important aspect which I'll try to cover over here, is that initially if we understand that in case when we need margins when we are trading. So when we are trading and we need margins can be placed in the form of funds as well as in the form of securities, right? So a lot of brokers will tell you kindly provide whatever margins are required, 50% maximum in cash and 50% in terms of collaterals or shares, right? That's what a lot of brokers will ask you, because that is a requirement that they also have to further on give to NCL, right? So initially you used to, the shares could be transferred from your own demat account to the client's, to the stockbroker's demat account. The shares used to physically get transferred for you to avail margin, right? Now SEBI has come up with the concept, something called as pledge. This is pledging of securities, right? So what happens in this pledge pledge in the pledge process, the shares will continue to be in your demat account, right? They will not move away from your demat account. Just like an ASBA facility in IPOs, here it will stay in your demat account. However, it will be pledged in favor of the stockbroker, who will in turn give it to NCL for getting margins, right? So movement of securities from your own demat account to the stockbroker's demat account is disallowed, and hence the mechanism that is replaced is the pledge mechanism, right? We will do only through the pledge mechanism. So margin pledge can be requested by you or as well as by the stockbroker, where the investor receives the link, then the OTP is then the OTP has to be given, and then the pledge is confirmed. These are the 4 simple steps through which you can execute the pledge. So pledge can be done. There's a concept called DDPI, which is called Demat Debit and Pledge Instructions. All of us who have been in the markets for quite some time have been using, for convenience as a power of attorney. So power of attorney definitely did have a lot of powers that could be given. So a lot of investors were facing some problems. So we came up with a different alternate mechanism called the DDPI, which is Demat Debit and Pledge Instruction. So whatever is related to your shares can be done through this DDPI mechanism. So I'll just play a small infographic video, post which we'll proceed. So it introduces what Demat Debit and Pledge Instruction is. Once it does that, I will go through that slide by slide. Yeah. Yeah. So if you see over here, I'll just come to this particular slide, which is more important. It specifically talks about 3 things over here. So a DDPI, instead of power of attorney, we can advise investors to go to DDPI mechanism, where this DDPI has a very specific purposes. They're very limited to three purposes over here. In case, for meeting the pay-in obligations for delivery and settlement of trades. Second, in case you want to pledge or repledge. And third is execute certain mutual fund transactions and tendering the shares in the open offer. So if you see over here, there are lots of powers the power of attorney could initially give. So using DDPI, it has been restricted to these 3 purposes. So for an investor, just to go backtrack a little bit. So for investors who do not trade very regularly, I would advise for them not to sign any, just issue a DIS slip in case you are there, or you can use an EDIS these days in case you're not trading a lot. But people who keep trading slightly more frequently, so DDPI is a very convenient way of giving certain powers. And in case you want to give more powers, only then the power of attorney comes into the picture. So for an investor who does not trade much, we can use a the DIS slip for sign and giving for delivery of shares. In case you are technologically very you can do it, then you do an EDIS. And last, in case you want to give, in case you're trading regularly and want to give certain more powers, you can use the DDPI mechanism. And these are the powers that you can give to the stockbroker. Okay, so this is a very important concept I will again add over here. So whenever we are trading in the securities market, it is always best for an investor to opt for a bill-to-bill settlement, which means settlement these days happens on T+1. So whenever I buy securities come to me within T+1. If I sell something, that funds has to come to me within T+1. So that is what we call as bill-to-bill settlement. So certain investors, what happens is, since they trade regularly in the markets, they feel that every time doing this transaction is inconvenient for them. So they said that let's maintain that we can maintain running account of funds. So whatever funds are coming in, the stockbroker can maintain themselves, and in case you are buying something from that account, it will get debited. So they don't want to do settlement on a daily basis. So they can say that we can do the settlement on a monthly or quarterly basis. So this is only for investors who are regularly trading. They could go ahead to make it hassle-free for them. As you can see, it's a voluntary document and not a mandatory one. So settlement can be done by the client as per the mandate. You can choose whether you want it to be a monthly settlement or a quarterly settlement. And with effect from October 22. The settlement has to be done on the first Friday of every month or every quarter. So that's the date. It's the fixed date. You know when your funds would come into your account. It's a fixed date, right? And in case there are no trades that you have done in the last 30 calendar days, the stockbroker has to return the credit balance to you within 3 working days, right? And please understand, we spoke about running account of funds over here. Running account of settlement is not allowed. Settlement has to be done within T+1, which is stockbroker has to transfer the securities within 24 hours of the payout, right? So the stockbroker will get it within T+1, and within 24 hours, they will transfer it to your Demat account, right? And as we covered, in case you want to take margins, then you, for margin purposes, you can use the margin pledge mechanism that is there, right? So these are the important points that I would like to again reiterate over here. This is a reiteration of what we have spoken. The contract note must be provided within 24 hours of the trade. Bill-to-bill settlement is advised. In case you're choosing running account of funds, then monthly or quarterly on the first Friday of the month or first Friday of the quarter, the settlement will happen. In case there are no trades that are executed, then the stockbroker will return the funds to you in case no trade within 30 days. Then running account of securities is not allowed, right? And stockbroker has to transfer the payout of shares within 24 hours of receiving it. And we will use a margin pledge mechanism only. So there are certain important points that we need to keep in mind while we are dealing. So no matter if you're new to the markets or if you've already started trading, some of these concepts is something that we should follow. So there are a lot of famous sayings that are there. I like to quote some of them. What should an investor do? So look at the quality business and not the stock, right? If you're willing to own the stock for 10 years, only then you must go ahead and buy. If not, you please don't own it even for 10 minutes, right? Check thousands of stock and look for high bargains. Scrutinize how well the management is using their resources. Stay away from hot stocks. Get rid of the weeds and water the plants, right? Market timing, as we discussed, is a practical, emotional impossibility, right? You cannot predict the movements, so it is better for us to be disciplined and do a systematic investment. Okay, a couple of myths we will demystify before I move on, before we actually close this session. So this is stock market is gambling, which actually it is not. Stock market in gambling, you're transferring the wealth from one person to the other. But in stock markets, if the price of shares increases, every single person stands to gain. Hence, it is not gambling. What goes up must come down. As you saw the markets over a 30-year period, we saw the markets, what goes up necessarily does not always come down. It goes up and comes down, but at the end of the day, we have a plus, right? The market is on top. So buy what's in the news. Absolute. Please do not do that. By the time we hear the news, there are a lot of professional people who are in the markets. By the time you open our trading account and you go and log in and place the trade, the price of it is already taken into consideration and market is already corrected. So let's not indulge in these forms of trading. So this is the last slide before I complete. So some things we have discussed over here. Obviously, Rachna will take up the next session, which is likely through active investing. So in case you need to learn more things about the securities market, one thing is the SEBI's website is there specifically for investors. They have the Sarthi app as well, and a lot of content, this clarification you can also get on our nseindia.com website. So these are the 3 sources to which you can go ahead and learn more about the securities market. So with that, I'll close my session. Thank you so much.
Thank you, Gaurav, for that. We have a few questions that we generally, customers generally have, right? So, do you want to do questions that are directed at topics that you covered now, or would we do all the questions?
We can take some of them and wrap.
Sure. Lovely. Okay, so the first question which we've seen people ask is, what exactly is KYC, and which of the following should form part of the account opening form, right? Like what parts of the KYC that they should be looking at when doing the account opening?
Right. So a very important part of KYC is the entire account opening form should not be left blank at all, right? Whatever we are entering needs to be entered, like the details whatever email ID, phone number, the address, all those things need to be provided in the KYC form. Along with that, we saw there's a mandatory set of mandatory documents and a set of voluntary documents. Mandatory documents would be your risk disclosure document, your agreement, what you're getting into with the stockbroker. The voluntary documents will be the DDPI forms and the electronic. The contract note should come to you in electronic or physical form. So these are things that are there part of the entire account opening form, which needs to be looked into very closely before we sign.
Right, right. And of course, don't sign anything that you've not filled in. Right?
Right.
I'm guessing that's what NSE is also saying. The next question is, what is an ETF, and is it a active or passive form of investment? And if you could expand on like why ETFs over like other forms of investment.
That's a really great question. The point here is, see, basically for very simply put, to understand ETFs, key what are ETFs? Let's not get carried away by the name. Basically, it says exchange traded fund. So basically, let's understand exchange traded funds as a mutual fund, but I can trade like a share. So if you see, every single product has some disadvantage. Like for example, a mutual fund cannot be bought and sold during an intraday cannot be done on the same day for a mutual fund. Same way, if you're buying a stock, there is a problem of diversification. A single stock cannot be diversified. So these are the two downsides are there in different products. So if you take away these two downsides, so I have a mutual fund that can trade like a share. So I'm getting the benefits of diversification as well as the benefits of the share, right? So that's a balanced product that we have. It's a very good form of investment to get in. And obviously it is passive form of investment because mutual funds and nothing or aim to track the market. So we're not actively buying and selling shares. So the mutual fund has, the ETFs has a particular a basket of products that we are buying and selling. So it's a passive form of investment.
Got it. Got it. You also spoke about settlement cycles, right? So, what settlement cycles? Firstly, do investors have the option to choose a settlement cycle? And if yes, what settlement cycle should they choose and use for?
Absolutely, good question. So definitely, investors do have the option. As I would again repeatedly keep saying to all our investors, those who are not trading regularly, I would urge them to go for a bill-to-bill settlement and don't choose for a running account authorization. So T+1 is when the settlement happens. So in case you are not going to earn any interest, you're not going to earn anything on it. So why not transfer it to your bank account or transfer it to your demat account? So settlement. So investors do have the option where they can choose what form of settlement they want. And if you're new to trading, don't trade regularly. Bill to bill is the best way to move forward. And those people who understand the markets better, they can choose, whether they want a monthly settlement or a quarterly settlement. And settlement happens of monthly and quarterly only for funds. It does not happen for securities. Running account of securities is disallowed. Only for funds you can do monthly or quarterly, right? So every monthly or quarterly of the settlement, and on the first Friday of that month or first Friday of that quarter, the settlement will happen. You can expect when exactly the broker will set your accounts.
Got it. Got it. So when you say a settlement there's no running account settlement for securities, what you would mean by this is all securities are directly transferred to the user's demat account, and hence nothing remains in a broker pool as such, right? That is
Precisely.
what you are hinting at?
Precisely.
Great, great. I guess that's the only few questions we had among the topics you'd covered. Over to you, Rachna. You can now get started.
Thanks, Tan, for those ample questions, and thanks to Tan for giving us an opportunity to be talking to the investors of Zerodha. So while Gaurav has touched on, what is that an investor should know when he decides to invest into the capital markets, and what are the various dealings or with his intermediaries that they should be sensitive about, what are the various documentations they should be aware of. He's covered all that in our previous sessions. I will be taking out this session to talk more on, one, you've been investing, but you've not been a very active investor because you've been trying out with respect to the asset classes. You already have some aspirations from the capital market investing, but you're not still into taking your own investment decisions based on a very uh, uh, information that is available and taking a very informed decision. So, considering all those, this presentation has been put in place to target the kind of investors who have been active. Excuse me, can I? Give me a moment while I share my presentation.
Of course, of course.
So this is this module is targeted towards the people or towards the investors who have already been investing into the stock markets, but they've been more or less guided by their friends and sometimes by people who've been active in the capital markets, but they've not yet taken control of their own decisions based on the information that is available. But now, having experienced the capital markets, having understood the final nuances of the capital markets, they're more confident in moving towards a higher active investing pace and taking decisions based on the information and the facts that they have researched about. And they're also now looking for a long-term investment with respect to an time frame and time horizon in mind. That yes, this is what we expect out of our investments. So if people who are in this frame of mind and who are in this stage of investing should be actually going through this presentation with great detail and depth in mind. I'll be touching upon what the primary market investment is about. And whenever an investor takes into decisions for investing into a particular sector or a company, what is the due diligence that it should be involved, that should be involved in the process? What are the various finer nuances of investing in the capital markets and some terminology surrounding it? I will also just touch upon the trading and settlement cycle for us to keep reiterating that, where do we stand with respect to trading and what is that we should expect from a settlement perspective from the clearing corporation. I will surely be talking about what is that NSE does for investor protection, investor grievances, and some important points that should be noted by an investor during his investing life cycle. So when I talk about primary market, having introduced the concept of what primary market is, just to have a recap of the same, primary market is basically securities which are issued directly by the issuer to the investors. So this is the first step of the security being rolled out into the capital markets by the issuer directly. So the issues could be public issues, which is meant for public at large for a lot of investors to subscribe it. And the issues could be rights issue, it could be a preferential issue, or it could be a bonus issue. So preferential issue obviously is something that is being taken between the company and the set of investors that are being allotted the shares. But public issuance, either if it is an initial public offering or a further on public offering, investors are invited to participate into the equity or the debt of the company. And that is where the primary market comes in. But there are scenarios where a primary market, a listed company also offers its existing shares to this investors, which is called as an offer for sale. So you will find primary markets for existing securities, and you will also find primary markets for newer set of shares that have been released to the public at large. So when an investor decides that yes, I am going to be indulging in an informed decision making before I invest in any company, it's important that they do a due diligence. Basically, the due diligence can be into two classified. The information can be classified as to information which is available, which can be viewed, analyzed, and information which can be perceived. So if I have to talk about information that's available, you can look at, an investor should necessarily look at the company financial statements. They should also look at who are the other competitors of the company and what is the company's performance in the sector, as well as what is the performance of the sector. So these are the informations that should be looked at by the investor before they decide of investing. The other important factors which should be looked at by an investor should be what is the company management, what is the background of the company management, what has been their disclosures with respect to corporate governance, how well it is perceived to be a governed company from a governance perspective. What is the perception of the people in those companies? Because some company name itself creates a lot of trust into the company, into the minds of investors. So we should also understand that, what is it about that company which builds so much of, instills so much of confidence among the investors. And that is what we should look out for other companies also when we decide to do a due diligence on. So, what is actually, if I were to ask an investor or somebody has to ask me, what do you think is a due diligence that should be, and why should somebody do a due diligence? Why should an investor do a due diligence? So, it's important that due diligence is done by an investor to assess what are the risks that he's exposing himself to, and what is that he should be looking at time horizons before investing. So these are the important factors that he will have to look into before he decides to invest and conduct a due diligence on the company. So like I said, it's important for due diligence, because without due diligence, it's like, you're driving a vehicle on a highway which is with a blindfold, not knowing where you're going, but driving fast. So diligence is important to understand that, what was the past performance of the company, and do the company show signs of similar performance in the future, and do I want to join this investing at this point of stage at the valuation that is being provided at the capital markets. It also shows that, what could be my expectations from this investment based on the past trends that the company has demonstrated. So it's kind of a proactive approach to decide investing rather than following what have been recommended to you. It is taking decisions, financial decisions in your own hands, and taking decisions based on research that has been conducted by you. So now the next question that comes up is that, okay, I know it's important to do due diligence, but this loads of information, this information overload, and what information should I look at, and where should I look at information? Because information is promoted by multiple channels, information is provided by multiple social media platforms. Do I trust those informations? How do I go about it? So what NSE would recommend to is that when you do a due diligence on the companies, the most important information sources could be the exchange website, because companies which are listed onto the stock exchange have to adhere to the listing agreement, which ensures that information is disseminated to the public at large, and that's an information which is authenticate information flowing from the company to the stock exchange. So that's the website, stock exchange NSE website, that people should refer to while they doing a research or a diligence on the company. This other authenticate information is the company website itself, where a lot of information is available for investors to take an informed decision making. A lot of publications are there on the research reports. A lot of regulated entities are doing research reports. Very marquee names are doing research reports. So those also could be studied by the investors to take a decision onto it. And there is some piece of information which is available on the social media from authenticate sources itself. So that could also become one of the sources for social due diligence. So if I were to say, due diligence is always going to be a kind of a multi-layered analysis. It depends upon, an investor to investor as to what is the approach they want to take towards due diligence. So you could have a bottom-up research due diligence that you want to do, or you could have a top-down approach to the due diligence. So if we were to talk about, what is the best method of doing a due diligence, whether it is a bottom-up or a top-down approach, I can say it depends again on the investor horizon. It depends upon the investor's understanding of the capital markets. So, and it could be a combination of both. So when I talk about a bottom-up due diligence that is done, it is done more or less by the investor on the fundamentals of the company, the competitive position of the company, the financial statements of the company. It involves actually studying the company at a granular level, and then taking your investing decisions based on the information available, and going for the investments. But when you talk about a bottom up approach for investing, then it is what happens is that you look at the macroeconomic factors. Then you look at how the sector wise performance, how is the sector performing. You look at the economic, you conduct an economic landscape study, you assess the economic landscape study, and then you decide that, okay, based on these factors is where I want to now narrow down my approach towards investing to some sectors, and then I study the companies on that sector. So like I said, it could be any one approach that an investor could take for doing a due diligence, or it could be a combination of the factors from both the aspects. um, Due diligence, what is the company and the industry analysis require? A quick check here is, we've already briefed it, but this is just a recap of what we have studied, and just to give some more parameters. So you can look at, cash flow statements, you can look at income tax statements, you can look at the PE ratio. Some of the important factors for decision making is also the exposure, the debt exposure of the company and the net worth. So how leveraged the company is with respect to its standing with the debt. So that is again a very important factor for some of the investors to take a call on the decision making. It's also very important to understand the promoters and their track record, and have a fair understanding of the business model, because if the business model is what we are able to understand and it's very simplistic, then we can actually take a decision, informed decision on whether you want to be aligning yourself onto such kind of an investing. If you don't understand the business model of the company, please think again before you take an investing decision into the company. So now, having understood that what the primary markets is, having understood that yes, you should do a diligence on how you can conduct a diligence onto the investing onto your investing options. It's also important to understand some of the terms which are very commonly used into the capital markets, and everybody uses them, but sometimes it so happens when we interact with investors, they're actually not aware of what happens behind those words. What is that this word what is that word talks about, or what is that it says? So when we invest in IPO, everybody says this is ASBA blocked. So now what is ASBA? ASBA says is application supported by a blocked amount. So if I were to explain an ASBA, what happens is you decide, you've done your research, you've done your due diligence, and you think, yes, this is a good option that is available for me, and I want to participate in the IPO of this company. So when you participate in the initial public offering of the company, you put in your bid, or your broker puts in a bid for you on your behalf based on your request. So once that is done, the next step that happens is an amount equivalent to the bid that you have put in will get blocked into your bank account. And once the amount is blocked, once the basis of allotment has been done and you have been allotted shares, then the amount gets deducted and gets transferred to the escrow account. But in case it so happens that you don't get the shares, the amount has to be amount is released. So what happens is the amount stays in your bank account. There's no abuse of the money that can happen by being transferred to any other account, and the money is transferred only in scenarios where you are allotted shares. And after deducting the amount of allotted shares, the balance will be unlocked. So this is very important when we talk about an ASBA back. It's a protection that has been offered by the regulator and implemented very well across, to ensure that the money remains in the bank account and is not abused, and there is no delay. In case the shares are not allotted, the investor is completely able to handle the money immediately, rather than again a to and fro between various intermediaries involved. So while most of us know what are the various trading and settlement mechanisms, it's important to keep reiterating these things, and that is why this slide and the next slide is going to be talking about what is the settlement and the trading mechanism. So the two boxes that you see are the intermediaries that are involved in the trading and settlement. So they are the market infrastructure providers. So one is the exchange and one is the clearing corporation. The exchange is a platform provider where the order matching and the execution happens. And the clearing corporation is an institution and entity where actually your netting of trades, your computation of obligations, and final pay in and payout happens. So exchange facilitates order matching and execution, whereas clearing corporation facilitates receipts of funds and securities. And then there is a role of a broker who plays an important role in bringing the buyer and seller to the exchange mechanism for the order matching and the execution. So this is a thematic or a diagrammatic representation of what happens once you decide to trade onto the stock exchange. So you have a broker who could have a buyer client, and you have a broker who has a sell client. So the order matching happens, and post the order matching, the information is passed on to the clearing corporation for the clearing and settlement. What happens at the time of clearing and settlement is the buyer has to pay in the funds that have been arising out of the obligation of his trade, and he has to pay in the money. The settlement happens on the T+1 day. He has to also, there's an upfront margin that's applicable to him on the buy transactions. And the payout of securities, that is, once he decides to buy, he gives in the funds and the securities have to be received by him. So this all happens within a process of T+1 day. So this is an advantage. Again, the shrinking of the settlement cycle from T+2 to T+1 has enabled the investors to turn their money faster and also to receive their money faster and capitalize on the opportunities that are available with respect to investing, and capitalize their opportunity to turn the money more and more. So just till what we have been a recap on, what Gaurav and I have spoken till now is about that, which of the following is not advisable while investing in securities markets. So obviously important is that you should always do dealings only with SEBI registered investment brokers. You should keep checking your running account, and you should keep the documents all signed. So what you should always not do is deal in cash. It has to be a big no. Whenever somebody approaches to you that yes, this is possible, please ensure that you know that you cannot deal in cash while you're dealing into the capital markets. Again, a very frequent question is whenever there is a talk about investing into the capital markets, people are being misled or guided upon that yes, you can expect a minimum fixed return or a guaranteed return of X percentage or an X amount. So please don't get lured by these kind of information or these kind of messages that are reaching to you. There is no fixed return or a fixed guarantee into the securities market. It's always, your returns will always be subject to the risk and returns, and there is no guarantee. Absolutely. I think some of the things that we wanted to highlight here is because this is more rampant more and more now on the social media and onto the various posts that we see, is these kind of messages keep floating around, and we wanted to showcase some of the messages that you should clearly avoid and not get lured by. We hear a lot of messages, or we hear a lot of information about tips that this is the most hot tip, please invest in this, but it has to be noted here that please indulge in your own due diligence before you decide to invest, and do not again get lured by the tips that are floating around, because you do not know what is the intention behind the people who are talking about the stock tips and promoting a buy or a sell on a particular security. We do not know what is the intention behind it. So please make a very informed decision making, conduct your own due diligence, look at your own investing horizons. Please look at your risk appetite before you get into this kind of investing or lured by such tips. Again, on what basis do you want to make your investment decision? So primarily it should be your own research. It could be by an advisor who is a SEBI registered, or it could be from trusted advisors that you think, but please do not go by the other areas that have been mentioned here. These are all our learnings over a period of time, which we wanted to talk to you about and caution you about, that these are the things which could be detrimental to your informed decision making and detrimental to your longevity of investments as well. Again, we have a lot of promotions wherein we see that these are products which will fetch you a lot of returns. These are the platforms which can actually give you quick money, easy money. So please refrain from even getting attracted and trying out trading in the products or the platforms that have been not regulated. So always deal with only regulated intermediaries, always deal in regulated platforms and products only. An important perspective that also sometimes is being misled is that even if you trade in this unregulated products and platforms, it is the exchanges will be responsible for the loss and the grievances that you have arised, that you have had because of the loss that you suffered because of such trading. Please note that investors will not be covered by the grievance redressal opportunities and mechanisms that are available for the trading for the investors when they trade in such unregulated products and platforms. Um, you've done a lot of research, you invested, but in spite of following all the good practices that are being known to an investor, you still have some dispute, and there is a redressal that you need to bring it to the forum of exchange. So you can immediately, these are the various options we put down, as we said, that you can seek clarification from your stockbroker. You can in fact still write it to him. You can retain copies of the communication to say that yes, you were trying to get your complaint redressed by the trading member, but in case you have not been able to get a redressal from the broker, you have to lodge a complaint with the NSE or with SEBI or with any other MII. So what are the various investor grievance redressals mechanisms that is available? So you have an investor service cell wherein you can go and lodge a complaint. It's a completely electronic platform which allows you to raise complaints sitting at the comfort of your house, providing information and providing seamlessly uploading all the information for the exchanges to gather the information accurately and accordingly facilitate the redressal. In case you're not satisfied with the redressal mechanism, or you still think that I don't want to go through the investor redressal mechanism and I directly want to go for a quasi judicial process, you have an option to go for arbitration. There is an appeal mechanism as well, and obviously court of law is also another option that you can look for grievance redressal. Like I told you, there's an online portal at NSE India website itself. There's a scores portal of SEBI, which is being very popular amongst the investors, and which is have strict timeline adherences for redressal of the complaints, which is being monitored across exchanges and the regulator. So that ensures that you have your time-bound redressals or updates on your complaints. How to file a complaint on scores, I've already explained this. It's a online portal. There are various steps to it, and once you submit all the relevant information, it will be taken up by the exchange through a panel or an individual outsider, which we call as an investor grievance redressal panel. So they will study your complaint, and the independent person will be the one who will be listening to the broker and the client grievances and giving an kind of a judgment on the whole matter. Once, it's also very important for you to know that you have been investing in multi-asset classes, and though you've been getting the transaction statement from the exchange, you've been getting your contract note, there is also a client consolidated statement that you receive from your depository. So which will give you a consolidated view of all your investments into the capital markets, your mutual funds, your debentures, your bonds, your sovereign gold bonds. So this is important for you to have it kind of summarizes all your investments into a particular statement, and you can just have one glimpse at it to know where you stand with respect to your investments, and whether there is anything that you feel that is not right or not correct. You can immediately bring it up for corrections, and also take any corrective actions if required based on the consolidated statement that has been given to you. So be an alert investor is what we tell all you have to be an informed investor, and you also have to be an alert investor. So please refrain from doing cash dealings. Please do not give anything unsigned and leave it to them, leave it to the peer, the broker, the intermediary, or the people who have approached to you that yes, we will do the remaining thing, just sign at one place. Please read your documents carefully. uh, Unregistered intermediaries, be very careful when people approach you for investing into capital markets. See what their sanctity is, what is their authenticity of the dealing into capital markets, whether they're registered intermediaries. This information is available on the NSE website, on the SEBI website. So please look for these sources of information before you deal with any intermediary who claims to be into the capital markets. Obviously, do not share passwords. Is applicable not only for your banking accounts, but also for your trading accounts, also for your Demat accounts. So that's a given. Please do not share your passwords with anybody. Do not keep your funds idle with a stockbroker. We have introduced the several mechanisms through which you ensure that the funds and securities are completely in your control and not abused. So the power of attorney, the DDPI, the running account authorization, all this is to ensure that your funds are with you, and even if there is some point of time you have some funds with the stockbroker, ensure that it's not ideal for it to be abused in any particular manner. um, Avoid herd mentality. Please do not listen to what everybody is doing, I must also. So the FOMO fear should not be applicable in the capital markets. Please do your diligence and um, take a decision that rests with your risk appetite, that rests with your investment horizons. Invest in businesses you understand. Do not try to time the markets. Do not trade based on stock tips, and do not fall prey to fraudsters for sending emails and SMSs promising huge profits. So again, at the cost of being reiterative, it's important that we keep remembering these messages from time to time, and know that we are an alert investor and we will stay alert investors. Points to remember while investing: since exchanges and the regulators are taking so many steps to ensure that you're regularly updated about your trades, about your statements, about your accounts, it's important that you please provide your updated mobile numbers and email IDs so that the information reaches to you right in time, the right information reaches to you. Keep verifying your account from time to time to see that there's no activity which is not done by you happening in your accounts. So please ensure that your accounts are regularly checked and your balances are verified. Electronic contract note is a very good method to ensure that they are reaching to you in a timely manner and into the email IDs that you have provided. And like we've again said, that please do not do cash dealings. Deal through banking channels only. Understand that what are your charges, what are your commissions that are payable, and you do not pay anything that is not required to be paid by an investor. So if I have to say, savdhani barte and satark rahe, so please exercise caution and stay alert is what I would want to say. Gaurav has already touched upon in our previous presentation as to what are the various things that you should look at if you want to know more about securities market. So these are the most common things that are being looked upon, and we would also urge each one of you that if you should look at this SEBI website, the NSE website, and the Sarthi app to know more about securities market and to stay updated about the developments in the securities market. I would just, in a nutshell, say again, this Soch Kar, Samajh Kar, Invest Kar, and that's it from my side. I would be more than happy to take any questions that have come during the session.
Thank you, Rachna, for that. We do have a couple of questions from users. Thank you, Rachna, for that. We do have a couple of questions from users. So, to begin with, I'm sorry, there was a technical error there where there was an echo of my voice. But moving forward, what are the fixed returns on securities available in the market? Like, to begin with, are there any products that offer fixed returns in the securities market, and what are they, if any?
Sorry, I'm just, give me a minute, I think. Yeah, sorry, can you please repeat because I just lost your voice.
Sure, no problem. What are the fixed returns on securities available in the market? Are there any products, first off, that offer fixed returns? And if yes, what are they?
No, there are no products in the capital markets that offer fixed returns. So please refrain from such kind of messages or such kind of information that is coming to you that we will give you a fixed return. So there is no fixed returns available.
Right, right. Also, you've received a what are these messages that we receive saying this is the balance of funds available with the trading member that the exchange sends to us, on a regular basis?
Yeah.
What are these messages, and what does a investor do with it?
Yes. So exchanges from time to time send out messages to the investors based on their trading activity, based on what is the funds that are available with the stockbrokers on a weekly basis or on a monthly basis. So it is requested that investors should look into these messages and also check that whether their banking statements, the messages or the bank balances that is being reflected is also what is reflected in their bank statements. They're able to cross tally the same. In case they receive trading messages, in case they receive that or trades messages, they should look at the contract note to see, yes, that this is what it is. My contract note also says that this is the amount that I've invested, this is the amount I bought for or sold for, and this is where NSE's message or the exchange messages for trading, and this is the obligation that is arising out of the trade. So it's important that they cross tally the information from time to time.
Right, right, perfect. We also have like a two-parter next. I'll present the first part of the question. It is, if like one wants to invest in a company, where would one look for relevant information, and what sources of information should one avoid when trying to make an investment decision?
Okay, so sources of information I've touched upon, but I'll repeat is that they should look for NSE website. They should look for the company's own website. They can refer to the research reports that are being published. So these are the most authenticate sources of information that is available. And what they should not look at is the unsolicited stock tips that they keep getting from random people who claim to be very savvy with respect to capital market investing, and who promise that yes, their investing has always led to such kind of returns. And so these are the things that they should stay away from.
Got it, got it. Now, so would you say it is in one's interest to have a financial advisor for helping you make financial decisions, like investment decisions?
Yeah, see, financial advisors, again, there is a SEBI regulation which talks about what a financial advisor can do and what he should refrain from doing it. So obviously, it casts a lot of responsibilities on them. And in case the investor is not equipped to, do his own diligence to the extent that is required, it is important that he deals with such trusted financial advisors and such registered financial advisors. In case he thinks that it is important for him to get advice from a third party, then in that case he should look at such registered and trusted advisors.
Right. Now, let us say I have a financial advisor friend, right? Like I have a friend who is a financial advisor. May not be my financial advisor, but is a financial advisor registered with SEBI. Now, does it make sense to accept any advice this friend gives when it comes to like investments or like buying a certain stock, things like that?
See, I can only say from our experience of dealing with investors is that sometimes the trust factor does grow a little detrimental to the whole investing horizons. So it's very important that if he's a financial advisor, so that's the given that he is supposed to do the right thing by it. It depends upon what is the advice that you're looking for, but financial advisor is friend or no friend, you should first see that it is a financial advisor who's offering you that services. And then again, do your diligence with respect to what has been his past track record, how he has been advising, what is the clientele that he's dealing with, what are the sectors that he's advising, and do you want to be associated with those kind of asset classes?
Right. So you heard it, folks. Whenever you're getting advice on your investment decisions, ensure you're getting advice from a registered financial advisor. This will be always in your interest. So don't accept advice from random stock tips or SMSs that you're getting to invest in random stocks. Not advisable at all. And just recapping what Rachna just said. And thank you, Rachna. Thank you, Gaurav. And thank you, Sriram, for your time. This this was a really informative session, and we hope to do more of these in the future.
We would also love to do more of these. And we'd love to get a feedback on this and see that, what is that more investors would be looking at from these sessions.
Sure. Any feedback that we do get, we'll make sure to pass along to you guys. Thank you for your time. I guess we'll wind up now. We've actually not overshot by much, so that is impressive. Thank you for also adhering to the time limits that we had. And we'll see you next time.